At first glance, this makes no sense. The most sophisticated financial institutions on Earth keep billions of dollars in cash reserves. Central banks hold trillions. Your grandmother probably told you to save for a rainy day. Yet mathematically, cash has been the single worst performing major asset class over the past century. The disconnect runs deeper than most people realize. Walk into any bank boardroom, and executives will explain their liquidity buffers as prudent risk management. Open any financial planning guide, and it recommends 3 to 6 months of expenses in savings accounts. Ask any retiree about their strategy, and they'll mention keeping substantial cash for security. These aren't reckless people making obvious mistakes. They're following conventional wisdom that has guided financial decision-making for generations. The mathematical reality tells a different story. Since 1900, a dollar held in cash has lost over 92% of its purchasing power. During the same period, that same dollar invested in stocks grew to over $18,000. Real estate increased by roughly 400%. Even government bonds, considered among the safest investments, dramatically outperformed cash holdings. The gap isn't close. It's a chasm that widens with every passing decade. This isn't about market volatility or temporary fluctuations. This represents a systematic transfer of wealth from cash holders to asset owners that operates continuously, quietly, and by design. The Federal Reserve targets 2% annual inflation, which means prices double approximately every 35 years. Your purchasing power gets cut in half while you sleep, while you work, while you save responsibly in the way your parents taught you. The institutional response reveals how deeply this contradiction runs. Banks borrow money at near zero rates and lend it out at higher rates, profiting from the spread. Insurance companies collect premiums in cash and immediately invest them in bonds, stocks, and real estate. Pension funds hold minimal cash positions, knowing that their obligations grow with inflation while cash holdings shrink. Even cash-rich technology companies like Apple and Microsoft deploy their reserves into corporate bonds and money market instruments rather than literal cash. Yet the advice flowing to individual savers remains unchanged. Keep cash for emergencies, build up savings accounts, maintain liquidity for unexpected expenses. The very institutions telling you this are simultaneously demonstrating through their own actions that cash represents a losing proposition over any meaningful time horizon. Consider a family earning $60,000 annually in 2000. Following traditional advice, they saved 10% of their income in a savings account earning the national average interest rate. By 2024, their accumulated savings would need to be worth 130% more just to buy the same goods and services they could afford when they started. The interest earned on their savings account fell far short of this requirement. Their discipline and frugality were systematically punished by the monetary system itself. The mechanism operates through multiple channels simultaneously. Inflation erodes purchasing power directly. Taxes on interest income reduce nominal returns. Opportunity costs compound as other assets appreciate. The combination creates a perfect storm of wealth destruction that most savers never fully comprehend until it's too late. Corporate treasurers understand this dynamic intimately. They maintain minimal cash positions, investing excess funds in short-term instruments that at least attempt to keep pace with inflation. They use credit facilities and commercial paper markets to access liquidity when needed, rather than holding dead money in bank accounts. Their shareholders would revolt if they discovered the company was voluntarily destroying value by maintaining large cash hoards. The real reason this hasn't been priced yet is not what most people assume. This is the part most people understand. Financial markets have spent decades building infrastructure around the assumption that cash provides safety and liquidity. Money market funds hold $5 trillion in assets, promising capital preservation and daily accessibility. High-yield savings accounts advertise rates that sound impressive compared to traditional bank deposits. Financial advisors recommend cash positions as portfolio stabilizers during uncertain times. The growth story seems compelling on the surface. As economies developed and financial systems matured, cash became the universal medium of exchange. Central banks gained credibility through independent monetary policy. Deposit insurance protected savers from bank failures. Electronic payment systems made cash-like instruments more convenient than physical currency. The entire edifice appears designed to reward savers and protect purchasing power. Institutional behavior reinforces these assumptions. Banks compete aggressively for deposits, offering promotional rates and premium services to attract cash. Brokerage firms provide money market sweep accounts that automatically invest idle funds. Retirement plan providers offer stable value funds and guaranteed investment contracts. The message from every corner of the financial industry suggests that cash represents the foundation of prudent financial planning. Capital flows support this narrative. During market stress, investors flee to cash equivalents. Treasury bills see massive inflows during geopolitical uncertainty. Bank deposits surge when stock markets decline. The flight to quality trade has become so predictable that entire trading strategies depend on it. Cash appears to serve its intended function as a safe haven during turbulent periods. Educational institutions teach this framework from elementary school through graduate business programs. Economics textbooks explain money as a store of value, alongside its roles as medium of exchange and unit of account. Finance courses emphasize liquidity management and cash flow analysis. Professional certifications require knowledge of cash management techniques. The academic foundation seems solid and time-tested. If you're interested in understanding markets beyond headlines, this channel focuses on exactly that. Government policies actively encourage cash savings through deposit insurance and tax-advantaged accounts. The Federal Deposit Insurance Corporation guarantees deposits up to $250,000 per account. Individual retirement accounts allow cash positions alongside stocks and bonds. Health savings accounts permit cash accumulation for future medical expenses. Policymakers clearly view cash savings as socially beneficial behavior worth protecting and promoting. International evidence appears to support cash holdings as well. Swiss bank accounts became legendary for capital preservation. German savers maintain some of the highest cash balances in the developed world. Japanese households hold enormous amounts of bank deposits despite decades of near-zero interest rates. Cultural differences in saving patterns suggest that cash preference reflects deep-seated wisdom about financial security. This is the part most people understand. The part that actually changes the outcome comes next. On the surface, the system still appeared coherent. The hidden structure reveals incentive misalignments that most savers never consider. Banks profit from the spread between what they pay depositors and what they earn on loans and investments. The wider this spread, the more profitable banking becomes. When savings account rates remain low while inflation rises, banks benefit at the direct expense of depositors. The institution promising to protect your money simultaneously has an economic incentive to erode its purchasing power. Central bank policy creates what economists call duration mismatch. The Federal Reserve sets short-term interest rates that determine savings account yields. However, inflation affects long-term purchasing power. This temporal disconnect means that savers experience immediate gratification from earning interest while suffering delayed consequences from inflation. The psychological reward cycle reinforces behavior that proves economically destructive over time. Tax policy compounds this misalignment through ordinary income treatment of interest. While long-term capital gains receive preferential tax rates, interest income faces the highest marginal tax brackets. A high-earning professional might pay 37% federal taxes plus state taxes on savings account interest. After taxes and inflation, their real return becomes deeply negative. The tax code actively punishes the behavior that financial advisors recommend most strongly. Corporate cash management reveals how sophisticated actors actually navigate this environment. Apple maintains approximately $100 billion in marketable securities, but minimal actual cash. Their Treasury Department operates like an internal investment fund, constantly deploying capital into instruments that provide better risk-adjusted returns than bank deposits. When they need liquidity, they issue commercial paper backed by their securities portfolio rather than selling assets. This approach maximizes returns while maintaining financial flexibility. Insurance companies face regulatory requirements to match assets with liabilities, creating natural hedging mechanisms that individual savers lack. A life insurance company collecting premiums today knows it will pay claims decades in the future. They invest in long-term bonds that mature when claims come due, protecting against both inflation and interest rate risk. Individual savers have no equivalent matching strategy available through conventional banking products. Pension fund management demonstrates how fiduciary responsibility actually works in practice. Fund managers who kept large cash positions during the past decade would face lawsuits from beneficiaries whose retirement security was compromised by poor returns. Professional money managers understand that nominal preservation of capital means real destruction of purchasing power. Their legal obligations require them to seek returns that at least match the long-term growth of liabilities. The behavioral economics of cash holding exploits cognitive biases that evolved in environments very different from modern monetary systems. Loss aversion makes people fear short-term volatility more than long-term purchasing power erosion. Availability bias causes recent market crashes to seem more probable than gradual inflation. Mental accounting leads people to treat emergency funds differently from investment accounts, even though money is fungible and opportunity cost apply universally. Financial intermediation creates layers of fees that extract additional value from cash holdings. Banks pay minimal interest to depositors while earning higher returns on the same funds. Money market funds charge management fees for providing modest returns above bank deposits. Even high-yield savings accounts offered by online banks represent arbitrage opportunities, where the bank profits from geographical or technological advantages rather than providing genuine value to savers. The same forces that once enabled growth now begin to work in reverse. Pressure accumulates first among long-term savers who discover their purchasing power has eroded despite following conventional wisdom. Retirees on fixed incomes find their savings buy fewer goods each year. Young families saving for house down payments watch home prices rise faster than their savings accounts. College students accumulating funds for education see tuition increases outpace their interest earnings. The most responsible savers suffer the greatest relative losses. Professional money managers absorb this pressure through performance metrics that force acknowledgement of opportunity costs. Portfolio managers who underweight equities in favor of cash face career consequences when markets rise. Financial advisors who recommend excessive cash positions lose clients to competitors offering better long-term returns. Institutional investors who maintain large cash buffers face pressure from boards and beneficiaries demanding explanations for suboptimal performance. The system persists longer than economic logic suggests because behavioral and institutional factors create tremendous inertia. Banks have no incentive to educate depositors about opportunity costs. Government deposit insurance removes market discipline that might otherwise force recognition of poor returns. Cultural norms around saving and financial prudence change slowly across generations. Educational institutions continue teaching frameworks that emphasize safety over purchasing power preservation. Regulatory structures reinforce cash holding through requirements that don't account for inflation risk. Bank capital ratios treat government bonds and cash as risk-free assets regardless of their real returns. Insurance reserve requirements mandate certain liquidity levels without considering opportunity costs. Fiduciary standards often emphasize principal preservation over purchasing power maintenance, creating legal incentives for suboptimal allocation decisions. Price reacts late because the costs of cash holding compound, gradually rather than manifesting as dramatic losses. A 10% stock market decline generates immediate headlines and emotional responses. 2% annual inflation creates equivalent damage over 5 years, but receives minimal attention. The timing mismatch between visible volatility and invisible erosion allows inefficient behavior to persist far longer than market efficiency models predict. Information asymmetries allow sophisticated actors to benefit from widespread cash preferences. Real estate investors use low-cost debt to acquire properties while savers accumulate cash. Equity investors buy dividend-growing stocks, while depositors accept fixed nominal returns. Bond investors capture yield premiums while money market participants settle for minimal spreads above government rates. The transfer of wealth flows systematically from those who understand the system to those who follow conventional wisdom. The system does not break here. It tightens. Cash remains the worst asset class not because of market inefficiency or temporary dislocations, but because monetary systems are explicitly designed to transfer purchasing power from cash holders to asset owners. Central banks target inflation rates that guarantee negative real returns for cash over any meaningful time horizon. This represents deliberate policy rather than unintended consequence. The mispricing persists because institutional incentives, behavioral biases, and educational frameworks all reinforce cash accumulation despite its mathematical inadequacy. Banks profit from deposits, governments benefit from consumption, encouraged by negative real returns on savings. Behavioral psychology makes gradual losses less salient than occasional volatility. The entire system operates to maintain confidence in an asset class that systematically destroys wealth. Confidence remains intact because the true costs remain largely invisible to most participants. Inflation affects all prices simultaneously, making relative purchasing power losses difficult to perceive. Tax systems obscure real returns through nominal interest taxation. Educational systems emphasize safety concepts developed before modern monetary policy existed. The psychological and institutional infrastructure supporting cash holdings proves remarkably resistant to mathematical evidence of their inadequacy. What would force reassessment requires either dramatic acceleration of obvious costs or widespread recognition of opportunity costs through generational wealth transfer. Hyperinflation would make cash inadequacy immediately visible, but would also destroy the broader economic system. More likely, younger generations raised with better financial education and different cultural assumptions about money will gradually abandon cash-heavy strategies that older generations considered prudent. This is what remains unpriced, for now. The institutional response accelerates as pressure moves from individuals to professional money managers whose careers depend on relative performance. Portfolio managers discover that maintaining recommended cash allocations systematically underperforms benchmarks over meaningful time periods. A pension fund manager who kept 20% cash allocation during the past 5 years now faces questions from trustees about why retiree benefits must be reduced, while competitor funds with lower cash positions maintain full payouts. The mathematics become impossible to ignore when fiduciary responsibility requires maximizing long-term purchasing power rather than preserving nominal account balances. Corporate treasury departments begin questioning cash management orthodoxy as inflation expectations become embedded in business planning cycles. A technology company maintaining $2 billion in money market funds realizes their cash position loses purchasing power faster than their research and development spending creates new products. Their chief financial officer presents board analysis showing that excess cash holdings represent a systematic transfer of shareholder value to depositors at other institutions who benefit from the lending spread. The opportunity cost calculation becomes a line item in quarterly earnings discussions rather than a theoretical concern. Banking industry dynamics reveal the mechanism through which cash destruction operates most clearly. Regional banks collect deposits paying 2% interest while lending the same funds at 6% rates for mortgages and commercial loans. The 4% spread generates bank profits while depositors experience negative real returns after inflation and taxes. This represents a wealth transfer system where savers subsidize borrowers through below-market compensation for their capital. The bank serves as intermediary, capturing the arbitrage while marketing deposit accounts as safe wealth preservation vehicles. Money market fund complexes demonstrate how financial engineering obscures rather than eliminates cash inadequacy. These funds invest in short-term government securities and commercial paper, providing slightly higher yields than bank deposits while maintaining daily liquidity. However, their expense ratios and the underlying securities' real returns after inflation still produce negative purchasing power outcomes for investors. The complexity creates an illusion of sophisticated cash management while delivering essentially identical economic results to traditional savings accounts. Insurance company asset liability matching reveals how sophisticated institutions actually manage inflation risk compared to individual cash holders. Life insurers collect premiums today and pay claims decades later, requiring investments that grow purchasing power over time. Their asset allocation models typically hold minimal cash positions, instead favoring inflation-indexed bonds, dividend-growing stocks, and real estate investments. When insurance companies do maintain cash reserves, they structure them as short-term bridges between asset sales and purchases rather than long-term holdings. Individual savers lack access to comparable institutional strategies that effectively hedge inflation risk. Federal Reserve monetary policy transmission mechanisms show how cash destruction operates by design rather than accident. When the central bank targets 2% annual inflation, they explicitly aim to reduce the purchasing power of currency and cash equivalents over time. This policy encourages consumption and investment by making cash holding economically punitive. The transmission works through interest rate suppression that keeps nominal returns on cash below inflation rates. Savers who follow traditional advice unknowingly participate in a system designed to transfer their purchasing power to borrowers and asset owners. International evidence demonstrates that cash inadequacy transcends individual monetary policy choices. European Central Bank negative interest rate policies charged institutional depositors for holding excess cash, making the wealth destruction explicit rather than hidden. Japanese households maintain enormous cash positions despite decades of experience with deflation followed by reflation attempts. Swiss banks historically attracted capital flight-seeking safety, yet their depositors experienced purchasing power erosion whenever global inflation exceeded Swiss monetary policy targets. Currency and political stability cannot protect cash holders from the mathematical reality of inflation's compound effects over time. The behavioral psychology supporting cash preferences exploits cognitive mechanisms that evolved in environments without fiat currency systems. Mental accounting causes people to treat emergency funds differently from investment accounts despite money's fungible nature. Availability bias makes recent market volatility seem more probable than gradual purchasing power erosion. Loss aversion creates stronger emotional responses to temporary asset price declines than to permanent cash value destruction. These biases persist because inflation's effects accumulate slowly while market corrections happen suddenly and receive extensive media attention. The mathematics remain unchanged regardless of institutional complexity or behavioral justification. Cash systematically transfers wealth from holders to borrowers through designed inflation targeting. The mispricing persists because the costs accumulate gradually while the benefits concentrate among financial intermediaries who profit from the spread. If this helps clarify how the system actually works, consider sharing it with someone who follows markets closely. This discussion is for educational and analytical purposes only and does not constitute financial advice.